Hello, and a very warm welcome. Today, we're jumping straight into one of the smartest ways to invest in the UK, looking specifically at the EIS and SEIS tax relief schemes for the 2026 tax year.
And this entire briefing has been put together for you by the experts at ProTax Accountant, designed to help savvy investors like yourself really get to grips with government-backed startup investments.
So, let's kick off with the big question, the one you're probably here for. How on earth do you legally slash your tax bill and at the same time get a slice of the action in the UK's most innovative new companies? Well, that's exactly what we're about to unpack.
Right, here's a quick look at our game plan. We'll start with what I call the smart investor's secret. Then we'll get into the nitty-gritty, comparing the numbers for IAS and SEIS for 2026. After that, we'll cover the 4 key tax advantages, show you how to claim your relief, and this is a big one, highlight 3 common costly mistakes you absolutely want to avoid. Finally, we'll talk about your next move.
Okay, let's dive right in. So, what is this big secret? Well, it's not really a secret at all. It's more about understanding why these schemes even exist in the first place.
And here's the key thing to grasp. These are not tax loopholes. The government wants you to do this. They've deliberately created these powerful incentives to encourage people to invest in new, high-growth UK companies. They know it's risky, so in return for you putting your capital on the line, they give you some truly significant tax breaks as a reward.
So let's get down to the brass tacks. There are 2 main schemes, SEIS and EIS. They're kind of like siblings, but they're designed for companies at different stages of their journey. Knowing which is absolutely crucial.
Okay, here they are, side by side. Think of SEIS as being for the tiny, brand new seed stage startups. The big headline here is you can invest up to £200,000 each year and get an incredible 50% of that back in income tax relief. That's huge, but the companies have to be small, fewer than 25 staff, and with less than £350,000 in assets. Now, EIS is the next step up for slightly larger, more established small companies. You can invest a lot more, up to £1 million a year, and the tax relief is a very healthy 30%. And pay close attention to that last row, because that gross asset limit for EIS is getting a massive boost in 2026.
And that brings us to a really important pro tip for 2026. The goalposts are moving, in a good way. The government is widening the net for what counts as a qualifying EIS company, and that means a whole new world of opportunities is opening up for you as an investor.
Just look at this number. From April 2026, the gross asset limit for an EIS qualifying company literally doubles. It's going from $15 million all the way up to $30 million. This is a game changer. It means larger, more mature, scale-up businesses will now be eligible, giving you access to a completely different tier of investments.
Now, if you think getting 30 or 50% of your investment back from the tax man was the only perk, then you're in for a treat. The benefits go way beyond that. Seriously, stay with me here. This next part might just surprise you.
You see, it's really a 4-part package. First, you get that brilliant upfront income tax relief. Second, and this is the real kicker for many, if your investment is a winner and you hold the shares for 3 years, any profit you make is 100% free from capital gains tax, 0. Third, there's a safety net called loss relief, which we'll look at in a second, to protect you if things go south. And finally, after 2 years, the shares are usually exempt from inheritance tax. It's an incredibly well-rounded set of benefits. So let's make that loss relief real. Imagine you're a marketing director in London paying the higher 45% tax rate. You invest £20,000 into a new SEIS tech startup. Right away, you get £10,000 back on your tax bill, so your actual cash at risk is only $10,000. Now, let's be realistic. Many startups don't make it. So if this one fails and your shares are worth nothing, you've lost that $10,000. But wait, loss relief lets you offset that loss against your income. At a 45% tax rate, that gives you another £4,500 back from HMRC. So add that to your initial relief, you've actually got $14,500 of your original $20,000 back. It's a massive cushion against the risk.
And here's another brilliant little feature you need to know about. You can actually carry back your tax relief to the previous tax year. So if you had a particularly large tax bill last year, you can make an investment this year and use the relief to get a refund on tax you've already paid. It's a fantastic, flexible tool for smart tax planning. Okay, so the benefits are amazing, but they don't just happen automatically. You have to claim them correctly. Let's walk through exactly how you get from making the investment to actually seeing that money back from HMRC.
It all starts with the company doing its homework.
Before you even hear about an opportunity, the company should have applied to HMRC for something called advance assurance. This is basically HMRC giving a provisional thumbs up, saying that the company and the share issue are likely to qualify. It's not a final guarantee for you, but it's a critical bit of due diligence that gives you a huge amount of confidence.
Right. For you as the investor, it really boils down to 3 simple steps. First, obviously, you make your investment and get your share certificate. Second, and you absolutely have to wait for this, the company will send you a special form, either an SEIS 3 or an EIS 3. This is your golden ticket. You can't claim without it. And third, use the unique number from that form to fill out the right boxes on your self-assessment tax return.
That's not all. Here's where most people go wrong. The rules for these schemes are incredibly precise, and even a tiny slip-up can be disastrous for your tax relief. This is where getting proper advice really pays for itself.
We see the same issues time and time again. The 3 biggest pitfalls are simple admin errors, like using the wrong bit of paper, investing in shares that don't actually qualify for the scheme, and just making a simple mistake when you're filling out your tax return.
And that first point is not trivial. Here's a real-life horror story. A company got all the right approvals for the super generous SEIS scheme, but when they submitted their paperwork, they accidentally used the EIS-1 form instead of the SEIS-1 form. A tiny typo, really. By the time anyone noticed, it was too late to fix. Their investors, who were expecting 50% relief, were told they could only claim the 30% EIS relief. A costly mistake born from a simple admin error.
And let me give you another expert warning. This one's a bit technical, but very important for 2026. A change in accounting rules means that from January 2026, things like long-term property leases suddenly have to appear on a company's balance sheet. This can artificially inflate their gross assets. Now, imagine a company that's just under the limit for SEIS or EIS. This rule change could suddenly push them over the threshold, disqualifying them entirely without them even realizing it.
So, we've looked at the massive opportunity, the fantastic benefits, and some of the very real traps you can fall into. The only question left is, what's your next move?
Let's just quickly pull it all together. First, EIS and SEIS are just incredibly powerful government-backed tools for investors. Second, remember the goalposts are widening in April 2026, creating more opportunities. Third, the benefits are a fantastic package deal: upfront relief, no capital gains tax, loss protection, and inheritance tax breaks. And finally, while the process seems simple on the surface, the rules are rigid. Getting it wrong is expensive, which is why professional guidance is not a luxury, it's essential. And of course, we must make it clear that the information in this presentation is for general guidance only. It's not a substitute for tailored advice. Before you even think about making an investment decision, you must consult a professional tax advisor, like the fantastic team at Pro Tax Accountant.
So we'll leave you with one final thought to ponder. Now that you've seen the potential, are you ready to seriously explore how EIS and SEIS could be integrated into your own portfolio and tax planning?
If that's a yes, or if you simply have more questions, then your next move is clear. Get in touch with the experts at Pro Tax Accountant. You can reach them directly on WhatsApp or by phone at 07985 689912. Or you can drop them an email at info@protaxaccountant.co.uk. And for more tax insights just like this, make sure you subscribe to the channel. Thank you so much for watching.